And I'm going to cover 3 topics here today. First, I want to give you a feel for where we are at financially on Illinois grain farms. So I'm going to show you what has happened to debt-to-asset ratios, current ratios, etc., through the high price period and then going down into the lower price period that we've had here recently. I'm also going to talk about incomes in 2018. And our incomes in 2018, even though we've had some dreary news about 2019, incomes in 2018 are likely to be pretty good. A couple factors are contributing to that: very exceptionally good yields, ability or some pricing opportunities earlier in the year, and also market facilitation program payments. Those obviously help a lot for the 2018 income situation. And then we're going to go into the outlook for 2019, which isn't as good as 2018. You'll notice here we have a blue line on this chart, which is net farm income. That's an average net farm income for grain farms in Illinois. So you'll notice in 2018, that number was $64,000. Just to give you a feel for that, that's Illinois grain farms enrolled in FBFM. The farm size of that changes over time, but in 2017, at the end of the year, that was a 1,700-acre grain farm on average, and there's quite a range of farm sizes in there from 500 acres all the way up to 7,000 to 8,000 acres. 1,700 acres, about 20% of the land owned. The remainder of it split between share rent and cash rent, about half in each. That varies across the state. Right here in this part of the world, it is split about half. You go into northern Illinois, it would be more cash rent. Go into southern Illinois, it would be more share rent. We were at $64,000 in 2017, and you'll notice there we divided those periods up pre-ethanol, before 2006, ethanol, higher price period, 2006 through 2013. You see soybean prices there. Could put corn prices there as well, same trend, and as you note, as those prices went up, we had higher incomes. Since 2013, we've had lower incomes, lower prices, and again, now in 2018 and 2019, we're looking at those soybean prices in particular, taking another step down. So obviously that is going to have a negative impact on prices. Taking a look at those periods, pre-ethanol, high price, and then lower price period, you can see those are higher incomes in that higher price period. And we also saw substantial financial improvement on Illinois grain farms. Debt-to-asset ratio is on the left. Current ratio is on the right. Debt divided by total assets. And you can see here that debt-to-asset ratio came down basically from the 1990s up till 2013. 2013, we had an average debt-to-asset ratio in this state of 0.18, which is extremely low. Since 2013, we've seen those debt-to-asset ratios increase. They're now 0.22. That is not a high debt-to-asset ratio on average. You can see that 0.22 is still lower than what we were in much of the 1990 period. But still, it's going in the wrong direction, right? Current ratio, measure working capital, current assets divided by current debt. That improved throughout that higher price period. We hit highs there. It's been coming down. At the end of 2017, it was 2.0. Again, that's a very good ratio, but it's been declining, and it has declined faster than the debt-to-asset ratio. Current position has worsened throughout this time period. Give you a bit, those averages obviously mask the differences in financial position across farms. Here we break out the number of farms in debt-to-asset ratio category. Less than 0.1 would be 10% or less of the assets are financed with debt, so 90% equity. Very strong financial position all the way up to over 0.75, and then at the bottom we list over 0.5. In 2015, we had 22% of our farms with over 0.5 debt to asset ratio. So more of the assets are financed with debt than assets. Those farms face financial risk, obviously. That decreased through that high income period to 7%. Since 2013, we've seen those numbers go up. It increased from 7% to 12% in 2015. Remember, we had zero income in 2015. So that's most of that jump happened that 1 year, and now we're sitting at 13%. Again, 13% of those farms are in a financially vulnerable position. That's still pretty low compared to the earlier period, but it's moving in the wrong direction. One other important factor to keep in mind as we're looking at these is that throughout that entire period, debt per acre did not, and I repeat that, did not go down. What actually happened was assets increased, both machinery and land. So a lot of that debt to asset improvement is actually in current or asset growth. We're sitting there again, 13%. Another thing to note on this slide, look at that less than 10%. That increased from 11% in 2005, 22% in 2013, and it's been holding pretty steady. If you're looking at 2017, there are 60% of the farms that are 0.3 debt to asset ratio or less. Those farms are very strong, right? Those less than 0.10 essentially are no debt. They could buy 80 acres today and not even probably talk to their lenders. So we got a lot of farms that are very financially strong, but the number of farms that are vulnerable are increasing. So that's where we're at. Financially strong, but our over 50% farms are increasing. Here is a little bit of more detail in 2017 of what those farms look like. So we divided that debt to asset ratio class, showed what they look like, gave the current ratio and working capital per farm for less than 0.1 to over 0.75. You can see current ratio has decreases with those higher debt to asset ratio classes. Over 0.5, we're underwater in a current ratio standpoint, current working capital standpoint. We don't have working capital. We have negative working capital. So those individual farms face difficulty. Another thing you'll notice about those, less than 10%, 76% of the farm is rented. That increases as we go up. Debt to asset ratio class, percent cash rented also goes up. Those farms that are more financially vulnerable have more cash rented, maybe at higher cash rents, and overall higher land cost. So that's what's putting those pressures on those upper debt to asset ratio categories. Again, that's where we're at. Now let's move forward. And for 2018, and now we're going to look at projections for 2018, we are thinking that incomes will be relatively good for 2018. And in fact, some farms are going to see pretty high incomes. That's going to happen for three reasons. One is we have had exceptional yields. High yields this year will contribute income, obviously, to our income statement. We also had a chance to price grain in early part of the year, spring. Our surveys, and this is soft science, this is really soft, would say that about 30% of the grain was priced during that period, expected production, which generally would mean that about 20% of actual production, given our high yields, was priced during that period. And market facilitation program payments. Those obviously will play a big role in 2018 income. Yield-wise, and again, yield-wise, we've had exceptional yields here in Illinois. On the left is corn yields. It's just phenomenal to think that we've had a 210 bushel yield in Illinois. 210 bushels. We were in Mount Vernon talking to some farmers there. 140 bushel APH yield was their APH yield. They had 210 bushels per acre. I mean, that's phenomenal. Yesterday we were in DeKalb, talked to a farmer. He was disappointed in his yield. He only got 230 bushels per acre. The point, though, of that one, he was disappointed with 230 bushels per acre. Now, a lot of that is built on the last 5 years of yields. Since 2012, we have had above average yields in Illinois. You can see that those below above trend yields since 2012, 14, 15, 16, 17, and 18 are above, and that's particularly so for soybeans. That does raise an important question here, and that is, what are you going to use when you do your 2019 cash flows? 5-year average is going to give you something very different than a trend yield. And we'll talk about that more, but one of the things I would suggest you do is to do a cash flow with 5-year averages and then use your trend-adjusted APH from crop insurance records and see what that looks like. Again, we have had exceptional yields in Illinois. And just to give you a feel, and don't look for this, this is a new slide, you will not find this in your book. But since 2013 to 2018, we've had an average of 6.8 bushels above trend in Illinois. And there's a number of states that have had high yields, and all of them happen to be along the Mississippi. Look there, and now make a comparison here between Illinois and our neighboring states, Iowa and Indiana. We've had an average 6.5, Iowa 2.5, Indiana 3.8. One of the questions is, why is there that difference? And there's several explanations. The most obvious is that Illinois farmers are better than Indiana and Iowa farmers. You might also think that weather played a role in that some way. But just not even, we have had really exceptional yields here in Illinois, and in particular central Illinois. So let's take that in mind as we're moving forward. The other thing that obviously is happening is market facilitation program payments. If you filed the paperwork, you've received the first payment. 82.5 cents on soybeans, half a cent on corn, 7 cents on wheat. You will be getting a second MFP. Now the question is, and this is sort of important, is what tax year you will be getting in. They are rushing to get it out before 2018 expires, so that would kick it into taxable income for 2018. We can bet on whether they get it done or not. My guess is that they do. So, and we won't know for sure till it debits your account. But that is an important thing for you to think about tax planning this year, because you're going to have another 82.5 cents hit your account on your production. Again, there's nothing you can do about that if you filed your production evidence. It's coming, nothing you can do. If you haven't filed your production evidence, wait till next year and you'll get the whole entire payment in that year. But there is a good chance that that 82.5 cents comes this year. So talk to your tax accountant. They'll love working over Christmas and thinking with you about how we're going to manage that. Another thing about these market facilitation program payments is that administration is adamant. There isn't going to be one of those next year, all right? You can believe them or not, But they say that there's not going to be one this year. But think about what it's done. It's $1.65 for soybeans. Say you marketed a crop for $8.50. That puts your price over 10, 10.25, 10.20. It's a good price and a good yield. You're going to make money on soybeans. All right? Again, moving forward, we're not looking for those to exist into 2019. So that's why 2018 incomes will be good. Here we're going to look at 2019 incomes and make a projection. My projections are going to be based on a $3.60 corn price, $8.50 soybean price. So I'm just taking what Todd gave us and running with it. So $3.60 corn, $8.50 soybeans. You already know this is going to look bad, right? But $8.50 is $1.50, $1.25, $1.25 less than we've been averaging the last couple years. You take $1.50, $1.25 off price, you're not going in the right direction. I'm building in here $7 per acre in PLC payments. 2019 crop, you get to make a choice. I'm guessing you're going to take PLC. Jonathan Koppas will talk more about that. Just to give you a feel for that, the reference prices for corn is $3.70. That kicks a payment. $8.40 for soybeans. That does not kick a payment at those prices. So that's where we're at. So that's built in there. We have increases in non-land cost, $25 per acre on corn, and I think I'm low on that. And I particularly think that if you didn't get your nitrogen on this fall, you're going to pay more for it in spring. So that $25 increase is based on a $580-ish dollar on anhydrous ammonia. My guess is if you haven't got it on, it's going to be equivalent of $600 this spring. So add another $12 to cost. $10 per acre in soybeans and cash rents remain the same. So nothing happens here in the cash rents. Here's our graph, and I'm going to start giving you projections here. And I'm going to give you three. Starting here at the bottom is minus $60,000. That's a $3.60 corn price, $8.50 soybean price, and trend yields. So we haven't built into that factor the last 5 years of good income. We go back to trend yields, which, by the way, isn't a bad yield. It's 205 bushels per acre around here. It still has a 2 in front of the yield, not a 1. So we're at 205 bushel per acre. That's minus $60,000. Why is that so low? Take $1.50 off corn or soybean price. Put very low payments in there for government. ARC PLC has been a good contributor to some of our incomes in the past years. It's $7. And put average yields in there. That $60,000 would be the worst we've ever seen, or at least since it'd be worse than anything we experienced during the 1980s. In the 1980s, we were close to zero. By the way, net income, this is net income. We typically use net income to pay debt, make debt repayments, pay for family living. So that minus $60,000, add another $60,000, $70,000 of debt repayments, etc., and you get huge $200-300 per acre losses in working capital. So that's what we're looking at there. Again, that would be very bad. So now, let's add to this. We're going to have good yields again. All right, good yields get us up to minus 3,000. All right, so add some yields there. That gets us up to minus $3,000. If you've been coming here, we have been low on net incomes projections for the past several years. The reason why is we would be using that trend yield and not above average yields. Here's the point, though. Now, those above average yields are just getting us closer to zero. Last several years, they would be pushing us up, 100, 120. We're still playing below the $0 line. So that's where we're at. Now the question is, what would take us to get back to sort of that average level? And I'm going to give you three scenarios here. First is we have above average yields, $4 corn, $9.50 soybean price. So we get $4 corn, $9.50, which would be above 9, right? We get back to sort of average levels, and that average level would just maintain us. We'd still probably see some erosion in working capital in some farms, but just maintaining us. Again, why are we there? We're seeing costs go up and revenue coming down. The other way to get there is above average yields and another market facilitation program payment. Again, the administration said that was not going to happen. The other way is a drought, over $5 corn and over $10 soybeans. Preferably the drought is in Iowa. That would help a lot here. And Ohio and Western Corn Belt. Drought, by the way, you're taking RP. We're going to take RP again, and things look better after a drought. Again, you can see here we're not projecting good. So, and in fact, 2019 could be very bad. Hopefully it won't be, but we're still, at this point in time, you would put over 50% probability that incomes are going to average less than zero in the state, which would be the worst we've seen. So what does that mean? Here are sort of the suggestions that we have at this point in time. The first one is to build working capital. And sort of a benchmark here is $2 of current ratio, or 2.0 current ratio, $300 per acre working capital. Let's build our financial position up to that point. And again, we're looking at good incomes in 2018. So let's save the cash. Build working capital as much as we can. And again, we're talking about averages. There will be some farms that this isn't a good year, right? We can find areas of this state with lower yields and for a variety of reasons. But on average, let's build that working capital and let's forego capital investments. All right, that's how we build working capital. Don't buy the equipment. So forego those capital investments, cut cost anywhere we can. Unfortunately, if you forego capital investments, your tax depreciation is going to be probably close to zero. So most farmers have written off previous purchases, Section 179 expensing, fast depreciation records. You don't forego capital purchases, you got a tax problem. 3, and do this before Christmas if you haven't done it already. This is an urgent thing. Conduct 2019 tax planning. And at this point, we won't know for sure. If we have a government shutdown tonight, who knows if it gets out in 2018? But think about, you probably, talk to your tax preparer or your tax planner will know this fairly quickly. You're probably going to be hitting another market facilitation program payment this year. Given tax planning, what likely that means is if you want to lower this year's tax liabilities, you're going to be shifting more of 2019 income in 2018, prepaying it. That has risk, obviously, because we'll be lowering expenses in 2019. I may have a high tax bill after 2019, but we're expecting that to be lower income year. Again, that strategy could backfire if we have a good income year next year, but that's next year. Why worry about that now? Your tax preparer can think of something next year at this time. So, those 3, And I would wait till after the holidays, Christmas, to do this one. Prepare a cash flow. Have a good time with your family. Just don't do this before Christmas. Prepare a 2019 cash flow. And I would suggest using prices of $3.60 corn, $8.50 soybeans. Right now, you could get close to $9 on soybeans. Build that in if you want to. $3.60 corn, $8.50 soybeans. That's not out of the realm of what could happen. All right? So build that in. Use two sets of yields. 5-year average yield, and get your approved yields for crop insurance, the trend-adjusted ones, and run a cash flow with that. My guess is your 5-year average yields, and most of your farms are going to be 20, 25 bushels higher on corn, maybe 10 bushels higher on soybeans. If you look at that scenario for number 2, it's a tough scenario. It's really tough. You will see negative numbers there. So you will see negative numbers. The important point to do with that scenario is to look at the magnitude of those and think about what we do if that actually happens this year. Because if that does happen, we will be making some very tough decisions next year. And getting a head start on thinking about what those will be a good thing. So do that cash flow. Number 5, begin marketing 2019 crop. If you believe Todd, $9 soybeans is a good price, right? That's $1 less than last year at this time. 9 versus 10. It may be psychologically hard to sell soybeans at a $9 price, but if you're looking at this now, that looks like a good price. And if you sell it, and that happens to be your low price, blame Todd Hubbs. He'll take all the blame for that. But in actuality, if that's your lowest price, you'll probably have a pretty good year. So, and we're not talking about, all of it, but begin marketing. If we're looking at where our crop insurance guarantees are going to come at in this coming year, $4 corn, we're still looking and this was done a couple weeks ago, $4 corn, $9.30 soybeans is about where we're at. We'll know that obviously at the end of February, but the important thing here to note is that our soybean guarantee is going to be lower this year. Next suggestion is to talk to landowners. One of the things that we have seen since 2013 is we've had positive incomes, but if we break out returns to land, we've done this by owned land, share rent land, cash rent land. Owned land, our cost would be property tax and any interest on debt, farm real estate debt. Most farms have very low farm real estate debt. So that's why our owned land has been positive for the past several years. It came down from 2013. Share rent land has been positive. Again, that rent adjusted downward automatically. And our cash rent land has been near zero, and that's at an average cash rent since 2013. If you think about it, we've had revenue declines, and cash rents have come down a bit, but they've not come down enough to offset the revenue declines. Moving into 2019, we're saying revenue declines are occurring again, and there's no government payments on the book that would offset it. ARC and PLC will not cover the losses. That trend yield scenario generates no cash crop insurance. So cash rents, been a push this past several years, will probably be positive in 2018 because of particularly on soybeans. But looking at 2019, it's negative. Here's what maybe a lot of farmers were thinking. Anytime we lower the cash rent, we have a huge possibility of losing that farmland, right? And there is a brighter times are just around the corner, right? I mean, and we were sitting there last spring, $4 corn, $10 soybean prices, they looked like a real possibility, and that makes everything work a lot better. Well, now we're looking at 9. 9 for soybeans. You can't build a scenario where we get back to 10, right? You can't get a scenario back to 10 until you get those ending stocks down. So we've just taken another hit off revenue, no crop insurance, so the possibility of that turning around, if we turn around, we get back to where we were last several years. We don't get better. So I would suggest if you haven't cut rents yet, and if you do a budget, it would say cut rent. You talk to your landowners and discuss with them, because again, come 2019, and our worst case scenario comes around, there will be some farmers that are forced to make hard decisions from a lender's perspective, right? We'll be sitting there being forced to make cash rent decisions based on from the lender. And again, you're looking at this, that they're now, the tariffs, the soybean situation caused a lower, intermediate term lowering in returns. And that needs to be reflected in cash rents. Considering acreage allocation decisions, again, our budgets right now would say corn is more profitable than soybeans. Do the budgets on your own farm. It's going to be touch and go. Again, we're seeing cost increase for corn. In this part of the world, the corn-soybean rotation will look pretty good, but do the budgets on your own situation. And again, we'll probably be seeing some switches to corn away from soybeans. So in summary here, this is the good hand, the bad hand. It looks like we're looking at a reasonably good year in 2018. Incomes will be good. Hopefully we're building, and it would be really good if we ended the year with more working capital and lower debt to asset ratios than we began the year with. If we don't do that, we do have a problem. But save funds from 2018. 2019 looks challenging, all right? So we're playing a lot of the time below zero net farm income. Could change. Hopefully it changes. This is agriculture and something good could happen, but still, if there's one thing certain about agriculture, things change, right? But still, we're still looking at that 2019 as being challenging. So the suggestion is save money, because we'll probably need that for next year, and talk to landowners.